Okay, welcome everyone. My name is Raman. Thank you for joining me today. So today we are going to discuss an interesting topic, which I find is not discussed enough. A lot of the courses and stuff that we take, I find I wasn't taught this properly. So I thought I will bring this up as a topic of interest for everyone. And that is the market correlations between different markets. So just a quick disclaimer before we get started. This is for educational purposes only. I'm not an investment advisor. So if you have any questions about your individual investment needs, I recommend you talk to your investment advisor. So the agenda for today's meeting is on market correlations. So we'll take a look at what are market correlations, what does that mean, how are the market correlations impacting our Forex trading, and then how do you profit from intermarket correlations, and how do you use it to become a successful Forex trader. So before we dive into that, just a little bit about myself. I am a full-time Forex trader. I have been trading live for about 8 years or so now, over 7 years. From education background, I have 2 MBA degrees, one from Cornell University in the US, another one from Queen's University in Canada. My background prior to financial industry was in IT technology. So I worked in IT consulting for over 10 years, and then in the financial banking industry for a number of years. And so currently I'm a full-time trader going through a process of setting up an investment fund at this moment, but I run a website called tradingwithvenus.com. So that's a little bit about me. So let's move on to the topic for today, and that is market correlation. So what exactly is market correlation? So in the form of definition, this is basically a measure of how two securities move in relation to each other. And when we're talking about securities, so now we're going beyond just the Forex market. So we are talking about gold, oil, this could be S&P 500 and bonds and things like that. So when we look at how any two securities, they move in relation to each other, that's called market correlation, and that's just the definition. So in today's webinar, we'll talk about stuff that's more related to the Forex, and I was actually looking at various different correlations, and I was trying to think of how much I should include in this. So today I'm only going to talk about the main ones here, and maybe we'll do another webinar where we talk about bonds and things like that. So today we'll just relate it basically just to the Forex pairs. All right, so positive correlation is when two securities move in the same direction with each other. And that would be, for example, your Australian dollar and gold. These are highly positively correlated securities. So when gold goes up, Australian dollar goes up. And we'll talk about this a little bit more. And then we have Canadian dollar and oil. So Canadian dollar, oil, very, very positively correlated. And again, we'll take a look at more of that as to why that is. We'll take a look into that. Actually, just a quick thing. If you are just joining, can you please put yourself on mute? All right, so moving on, and next thing is inverse correlation. Inverse correlation is when two securities move in the opposite direction to each other. For example, US dollar and gold are inversely correlated. When gold goes up, US dollar goes down, and when US dollar goes up, gold goes down. And we'll talk a bit more about that. So let's start off by taking a look at Australian dollar and gold. So like I mentioned before, gold and Australian dollar is positive. They're both positively correlated. And what that means is that when gold goes up, Australian dollar goes up. So let's get into a bit more detail as to why that may be. gold is one of the main exports of Australia. So Australia is actually is the third largest producer of gold. So when other countries or when people have to buy gold, they have to exchange their money and buy Australian dollars so they can buy gold. So we don't always do that, because this is, when we go to a jeweler store or wherever to buy or bank to buy our gold, we just give our currency and get the gold. But now let's take a look at supply and demand. When the gold is actually mined and is exported to other countries, the trade that happens, you have to buy Australian dollars to actually buy the gold, and then it gets distributed to other places. So because of that, because we are using Australian dollars to buy gold, so there is a demand that gets created for Australian dollars in order to buy gold. And as a result of that, when gold prices go up, you have to actually exchange and get more Australian dollars in order to be able to buy that. So gold and Australian dollar, they both will go up in the same direction. So they're positively correlated and they go up in the same direction. So if you just wanted to take away one thing from that, it would just be that Australia is one of the third largest biggest producer of gold. And as a result of that, when they produce more gold and they sell more gold, the currency goes up as well. And same with oil and Canadian dollar. Canada is a resource economy, so we are heavily dependent on our resources. It used to be forestry before, and now it's oil. Oil is one of the main exports for Canada, and the largest customer for Canada in terms of oil is the US. So we here produce a lot of oil and we sell it to the US because we are closely tied with the US economy. So when the US economy goes up, there's more demand for oil, and as a result, they're buying more oil. So when more oil is purchased, you have to again convert from US dollars, Canadian dollars, and the demand for Canadian dollar goes up. And as a result, Canadian dollar will go up. So because these economies are so heavily tied to their resources, so Australian dollar is tied to gold because they produce a lot of gold. They're also tied to iron ore. So if you're trading commodities in general, you'll notice that when iron ore prices go up, Australian dollar will go up as well. But because we don't really use that for Forex, I haven't really brought that in here. But with US dollar and Canadian dollar, you will see when oil goes up, Canadian dollar will go up. And what that means is because our charts are always represented in US dollar CAD, so US dollar comes first. So that means that there will be an inverse relationship between US dollar, CAD, and oil. So when oil goes up, Canadian dollar goes up, but US CAD will go down. So let's move on to the charts, and we'll take a look at some of these charts so I can explain this a bit more. So I'm actually going to switch on to my chart here. I'm using MT4. So let's take a look at, let's do Aussie and Gold first. Okay, so here's the Australian dollar. This is the latest chart that we have, and this is from Friday. So here we see Aussie has been going back and forth. So let's take a look at gold. Actually, let's take a look at the daily chart here so you'll see it a little bit. Okay, here we go. See how Aussie was going up? So we had a number of days of basically Aussie was in this uptrend. And if you take a look at gold here, see how gold was in an even larger uptrend as gold was going up, Aussie here was going up as well. And now gold started coming down for the last number of weeks here. So we see March, April 25th. So May basically here, starting May, beginning of May, it has been going down. And as we see here, Aussie actually started going down sooner, and that's tied to the Aussie US dollar here as well. But from May onwards here, we are definitely going down, as you can see. So there is a relationship between gold and Aussie here. Okay, so let's move on to Canadian dollar. We'll take a look at Canadian dollar and oil here. So here, this is one of the trades that I actually marked up, and we can go through this in a bit, but let's take a look at overall market moves here. So here we see dollar CAD. It has been going down, and lately, we have seen it go up and then go down a little bit. But let's take a look at this one right here. So we see US dollar CAD is going down, and we'll take a look at the oil here. Oil is, as we can see here, it has started going up in January, and it's going up. So Canadian dollar and oil are move in the same direction. So in this dollar CAD, Canadian dollar is a second pair. So it's inversely related to US dollar CAD. So as we can see here, it's been going down. Dollar CAD has been going up while oil has been going up. So this is the relationship that we want to understand and actually trade so we can profit from it. So in terms of just visually looking at it, as we can see, US dollar moving, dollar CAD moving down, and oil moving up. So there's a clear inverse relationship between the two. So now let's understand, how do we then take advantage of something like that? So how do we know? So conceptually, yes, we understand when gold goes up, US dollar will go down, or when gold goes up, Aussie will go up. But how do we actually use this information to actually profit from it? So let's dig into that, and I will go into the chart that I have marked up here to help understand that. Okay, so just by knowing that when oil is going up, dollar CAD will go down. First thing we need to do is actually, okay, so let's backtrack a little bit. So in terms of correlation, how much is the correlation? How big is the correlation? So that is 80%. So 80% of the time when oil goes up, Canadian dollar will go up. What that means is that 20% of the time, these correlations won't work. There will be times when there's an external market condition that makes it such that the correlations don't work. And that can happen quite often. So that's why we have to keep track of them and only do this when it's actually, when they're correlated. So only take these trades when they're correlated. So keep an eye on that. So what are some of the reasons that will make them not correlated? For example, let's say Canadian dollar, for example, interest rates get cut. That will push the Canadian dollar down, and it may not have the same impact on oil, but it may push the Canadian dollar down. As a result, we may see Canadian dollar dropping while oil may still be holding its level. So that's one scenario that's very, very important. Or another thing is, let's say we have some economic news come out, or there is some geopolitical event that happened. So in that case, we may also lose these correlations where for a short period of time, market may just move in completely opposite direction. For example, we have been seeing lately in euro and pound, they are usually two positively correlated currencies. And by that, when euro goes up, generally pound goes up, and the vice versa. When euro drops, generally pound will drop as well. And you'll notice when there's negative numbers that come out for one, usually the other one gets impacted, even though they shouldn't be, because they're two different countries. So there is correlation that exists. However, when we look at the charts for the last few days here, as we can see, they have been moving in opposite directions. So here's the euro. Euro had dropped, and as you can see, pound had been going up. So there's the correlation between them is not working, because euro was all moving down. So this is the euro daily chart. So we see that it's been moving down quite a bit. Whereas the pound here, if you take a look at it, it was going up. So that positive correlation wasn't really working between the two. So just be aware that there will be at least 20% of the time when this won't work. So pay attention to what the charts are showing you and keep an eye out for like other external events and news that are going on, so that you can you fully understand what's going on in the market and only trade when these correlationships are actually working. So just a note there, keep that in mind. All right, so now let's take a look at going back to our example here. How do we trade this? So here we have, this is dollar CAD, and I drew this example on Friday. So this is the latest chart. This is May 27th, 2016, and Friday. So what we see here is there was a push up in oil here. This is in dollar CAD. So this is dollar CAD. So we see there was a push up in dollar CAD, and then it started hitting this support and resistance level right here at 30.67. And at the same time, what you can do is go to your chart for oil. Right here, I'm using WTI chart. There are two different oil charts. You can use Brent or WTI. Brent, if you're in Eurozone or UK, Brent is what you watch. However, in North America here, WTI is what most people go by. But they're usually fairly close in price. There may be slight difference in price, but you can use either chart. It doesn't really matter, because technically they should move together in the same direction. Okay, so dollar CAD here. So you see dollar CAD run into problems. So go to your chart and look at the oil here. We see here oil came into the bottom here. It came into support, started basing out. So it tried pushing through and it wasn't able to go through. Look at the number of attempts that it makes in pushing down, and then finally starts to go up. So generally, because oil will tend to move first. So we want to look at the commodity first and then the currency. So when you start seeing that dollar CAD is running into trouble, switch over to your oil chart and see what it's doing. Or what you can do is keep an eye on oil, and when you see that it's starting to run into trouble, wait on your dollar CAD chart, because oil will tend to move first and then your dollar CAD will move. So here, let's take a look at the time here. So this is 1600 hours is when this happened, and I'm going by the London time here. So London, May 27, 2016, 1600 hours, we saw that the price of dollar CAD was coming into resistance here. And when we flip over to our oil chart, you'll see May 27, 2016 at 1600 hours, there was this basing formation that was formed in oil as well. So you see that oil is basing out, as well as Canadian dollar. It is coming into resistance. Oil is coming into support. So this tells you that it looks like it will start to turn now. So it takes a number of times, and oil is not able to move. And as you can see, Canadian dollar starts to turn. So once you see that oil is basing out, you can take a trade in Canadian dollar as well. I wouldn't recommend taking a trade both in oil and Canadian dollar, because then you are putting too many of your eggs in one basket. So if the trade doesn't work out, then you're losing twice as much. So you can pick one. So you either trade the oil, or since we trade Forex pairs, we can trade dollar CAD. So once you start seeing that oil is coming into trouble here, you can take a trade in dollar CAD. So you would expect when the oil start basing out and looks like it doesn't want to go any lower, generally when something doesn't go lower, it will go higher. So here we see tweezer bottom. So from a technical setup perspective, we see at 1600 hours, there's tweezer bottoms, and this is a reversal signal. So when you see price coming down, rejects, and the price rejects, and then closes up here, so with two pins, so that's your signal that oil may start going up. And then you look at this one, this is a double bottom now. You see a nice engulfing candle. This is a reversal double bottom. It's a reversal pattern as well. So you can look at either one of them and look for a trade. So in this case, it takes us, this is 1600 hours, price was still going up, it closed very bullish, so there's no trade here. Then you move on to your oil, you see that it's starting to base out, right? So you wait for it, and then here you see you have a double bottom, and in this case, you kind of wait. This was 1600, so 5, 10, another 15 minutes later, you see a pin bar. So here what we notice is once it's not, even with the bullish one, bullish candle, it's not going any further, it's not going higher. And then we start seeing a pullback. And here we see a lower high, and the price closes with a pin bar. And if you look at your volume, if you use volume, if you look at your volume, you see that your volume is actually decreasing. So the volume here is larger, but here it has gone down. And once you get this red candle, of course, you know, volume drops quite a bit. But I would take an entry right over here. And actually, this was a trade that I took. So once this candle closed, I took a trade here. So your stop loss will go up top. So, and keep an eye on your oil chart to make sure that it doesn't, you know, start going lower. Here we see the same thing. So 1600 hours, 1, 2, 3, so 4, about 20 minutes later, you have a big or an engulfing candle. So you have your double bottom pattern. You can take an entry here. This is aggressive, or you can take an entry after this red candle is formed. In that case, your entry would be at the back test of this pin right here. Generally, what happens is when you get engulfing candle, it will go and back test this pin. That has been my experience. So you can take an entry on the 50% pullback of this candle. I took it a little bit early because I was expecting this to happen. However, if you're not sure, you can wait for this red candle to finish, because then you know, then you're perfectly aligned. This is 20 minutes here, 20 minutes here, you have a double bottom and you're expecting it to go up. So you're perfectly, this is a more of a confirmed entry. If you wait for this red candle and then you take 50% pullback, your stop will still be there. Your stop will still have to be above the high here, and you're looking for price to come down because you're looking for oil price. You're expecting the oil price to go up, and dollar CAD as a result will come down. So what we see here is dollar CAD dropping till we come into this support and resistance area over here. And here, as we can see, the same double bottom, so not the double bottom, the tweezer bottom type of pattern. So price tries to break through, it tries to break through, and then we get an engulfing candle. So that's a good signal for exiting this trade. And here, as we see, as the oil price starts moving up, we saw dollar CAD started going down. So this is the trade we were looking for. And once you see over here, look at this, we get a pin bar, and then we get another inside bar, and then a strong reversal bar here. So now at this point, we see a reversal that starts to happen in oil, and this is 1840. So about 2 hours and 40 minutes after this trade started, we see this type of a reversal setup here. So here we see another pullback here, but see, this is not an engulfing candle. So even though we see pin bar here, this is not really an engulfing candle, and this pin bar was on top of a green candle. So here we see actually a bearish pin bar, and then we see a bearish engulfing candle. This, at this point, price has tried 3 times to break through, and it hasn't managed to. So at this point, we could get a pullback, or we could get a complete reversal. So it's time to close the trade. And if you look at dollar CAD here, this is 1900. So this was when we started getting our, so about 20, this green bar was the 1840. So this is where we started getting our reversal signal. Price started moving up. It did do another push to the downside. And once you actually see your reversal signal here, you see 2 pins, and you see your bullish engulfing candle, or you can, choose to get out on the second bullish engulfing candle, whichever one you choose to get out on, either one. But time to close the trade out, because we see that the oil is starting to reverse, and at this point we don't know whether this is a pullback or a reversal, but it's certainly a reversal signal. So we want to respect that, and likewise we see that oil starts basing out, and dollar CAD starts basing out, and then time for us to get out. This here was actually Yellen, and then Yellen came, she had her speech and it pushed everything back up again and stuff like that. So again, like I said, with the fundamentals, things can get skewed. So anyway, so point is there was a reversal signal here, so we get out of the trade. So to recap this, we are keeping an eye on both the dollar CAD and the oil. So I keep both of my charts open when I'm trading these pairs. Keep both of the charts open. Once I see that one of them starts to look like it's topping or bottoming, I take a look at the other one. Generally, you want to look at your oil first, and then your dollar CAD, because commodity will start doing something and then you'll see the currency reflect that. So I generally look at my oil and then I'll go on to my dollar CAD chart. I want to see that there is some sort of topping or bottoming formation in both of them. So this could be, oil could be going into support, and dollar CAD at that point should be going into resistance. So if you see that dollar CAD is not going into resistance, you see something like this, there's no trade, right? So you want to see a signal in both of them, not just one. Generally, oil will tend to get you a signal, give you a signal first. You'll see that it's starting to reverse, and then likewise, you'll see that dollar CAD will do the same. So for example, here, this after Yellen, we saw that oil was still going up at this point. It based out and then started going up. That would be a good indication that dollar CAD will start going down, and as you can see that it goes down. But if you have things, external things like Yellen's speech from the Fed in the U.S., time to stay out of the trade, this trade ends here. But as you can see, in terms of correlation, oil was still going up because oil doesn't have that much of an impact when it's Yellen's speech related to US dollar. So oil will do what it wants to do. And you can see it's still going up. So this will indicate that our Canadian dollar CAD will actually come down because this starts happening. Oil is still going up, right? Which means Canadian dollar should be strong. So dollar CAD will be weak, and we can see that happening. But when there's external events like Yellen's speech and things like that, it's better to stay out of that trade at that moment. Yes, I generally look at not just 5 minutes. So I do trade Canadian dollar based on, by looking at oil. So if it looks like Canadian dollar CAD is going to come down and oil is coming down as well, I will not take a trade. So I am looking for that correlation between them. And if they're going in opposite directions, there's usually not a trade. If it doesn't make sense, don't take it. But in terms of the charts that I look at, so when I start looking at my charts, I always look at the daily first, then I look at 4 hour, 1 hour. So every hour I look at my 1 hour closes to see what's going on with that. But when I enter the trade, I generally enter the trade on a 5 minute chart. So the 5 minute chart is mostly for entries because 5 minutes charts can be quite noisy when you're trying to take trying to stay in a trade. So the oil news is Wednesday. So a good point. Thanks for bringing that up. So every Wednesday we have oil inventories that come out. So there's oil inventories that come out every Wednesday, and it's generally at 10:30. This is actually a good time to take, well, no, not when the news is coming out, but after the news has come out, because what happens is if there's an oversupply of oil prices will come down. So anytime you get news, but there's two different things that they're looking at. So pay attention to that and wait for things to settle down after the news, because sometimes it'll start moving in one direction and then reverse directions. So give it, let's say, 15 minutes after the news. But generally what happens is when they say there's an oversupply of oil inventories, oil will go down. And as a result, dollar CAD will go up. So that's a good one to pay attention to. Wednesday is a good day to look at this correlation, especially because oversupply of oil means in the inventories, which come out at 10:30 Eastern on Wednesdays, you will see that it goes when there's an oversupply, oil will go down. As a result, US dollar CAD will go up. If there is a drawdown on the oil, on the inventories, so normally you will hear your squawk, or if you look at Forex Factory, it will say there's a drawdown on the oil, in the oil supplies, in the inventories. If there's a drawdown, oil will go up, because that means people are using oil, or the businesses are using more oil to produce their products. As a result, oil will get pushed up and dollar CAD will go down. So that's a good place to look for, or to take advantage of that interrelationship. But give it about 15 minutes after the inventories, because what happens is there's a quick market reaction to the news, and then they look at the second part of the news, which will kind of go in the opposite direction, and everything gets messy. So best to let the market digest the news. So give it about 15 minutes or so. So you may not get the entry at the very top, but if you get an entry over here, that's a good thing as well. So don't worry about it. Look at this trade. There was a pin bar here that you could have traded. Your stop loss still goes up top here. So there's time. So you got 5, 10, 15, 20, 25, 30, 35 minutes, 40 minutes here to actually get into the trade. So the trade hasn't run away from you. So you have time. So just like the oil inventories, just give it some time. And when you see that the market has settled down and it's found a direction, you can take a trade there. But you will really notice that when there's a drawdown in inventories, oil will go up. And when there's oversupply, oil will go down. Oh, another thing that to just point out, actually, because this happened recently. So there were problems with, in Canada here, Fort McMurray, there was big fire. And as a result, the oil supplies went down, or the market reaction was that because there's a big fire, it threatens the oil supplies and the disruption in that, actually, because Fort McMurray is a big place where a lot to do with oil production. So when all the businesses and everything's destroyed, there'll be disruption in business and the oil production. As a result, oil prices went up. And in Nigeria, there was a problem with disruption in the supply, again, in the pipeline and stuff. Because of that, oil went up. So if you look at any like Saudi Arabia or places like that, if there's a problem, there will be, you will see that oil will react. So there's other question, do I look at bonds and S&P, and do I look at bonds and commodities and other currencies? Yes, so we won't cover the bonds and S&P. I was going to cover that, but we don't have enough time to get into all of that. So let's move on to another one that's directly related. So I think I'll do another webinar to cover bonds, S&P, and their relationship to, because there's definitely a big relationship between yields and the currency price. I'll cover that in a different seminar. And also stock markets and US dollar, it has direct or relationship as well. So we'll cover that in a different seminar. But so the other relationship that I want to talk about is Australian dollar and gold. So like we discussed before, when gold goes up, Australian dollar will go up. So as we can see here, November, December, here January, December here 31st. So January, gold started going up. So we saw this bottoming formation here in gold. As you can see, this rounded formation, this is usually a bottoming formation. So if you see that the price starts hitting a wall and it's not able to break lower, so we see double bottom here in gold, this is an indication that the price will start moving in the other direction. So this is on a daily chart, so very important. So you have double bottom here. So the first thing to notice would be, to keep an eye on, would be, is there a bottoming formation, or is there something going on in oil? So here we see there's a double bottom, price came and tested the same level, got rejected, and here we can see it's two bullish bars, so completely got rejected at the bottom here. So after all of this, after it has stayed in this range for so long, it's got to go somewhere. If it doesn't go down, the next place it's going to go will be up, right? So price was coming down here. And once it stopped going down, starts bottoming out and starts pushing off of this level, next thing we have to see is that it will go is up. So you can draw the way to trade this actually would be draw your, this rectangle here, and you're looking to take a trade over here. This is a confirmed entry trade, so you can take a trade. And as you can see, it goes up all the way. But this is just a kind of 1 minute thing on bottoming formations. If you see prices coming down, it starts to bottom out, any kind of a reversal signal here, you draw the box around that range. And then once the price break out, don't really need to take a trade here, because it could be a fake out and then it goes down. So you take a trade on the back test and the close above the range. So that's just a little tip there. So we look at the gold and we notice that it starts bottoming out, and here it starts going up. So let's take a look at Aussie dollar here. See, so gold, we saw that 31st of December or the 1st of January, it had started going up. And here we see 15th, so Australian dollar is still moving down. So we see a divergence, and then Australian dollar starts to do this, and then we see a spike down. And so there's a divergence now, and this is what we're looking for really. We're looking for a divergence between the price of gold and Australian dollars. Like same way we were looking for divergence in price of oil and Canadian dollar. So we always look at the commodity to move first, and then the currency should follow. And sometimes, as we can see here, it can take a few days. So Australian dollar does this, starts to base out, and then does another drop, and then finally see that it starts to base out here. So we have bottoming formation where price is, we have a big down candle, but then we see a bullish candle, another bullish candle, and then a big pin bar, right? So now 3 days or 4 days of trying to push lower, price is not able to do that. And generally this would suggest that it will start going up. And already we see that the gold has started moving up. So if you look at, so this was December 31st. So we have gold has already bottomed out, and now we are looking at January 4th, the gold starts moving up, and January 15th, so it starts coming down a little bit where we saw the Australian dollar push down, but it's still higher than so the low, it's making higher lows than the previously here, right? Whereas Australian dollar was making lower lows. So Australian dollar will generally tend to go in the same direction as the oil. So this Australian dollar will start to adjust, right? So that's what we're looking for. Anytime you see a divergence, so there's gold is going up, Australian dollar is going down, wait for Australian dollar to bottom out, and you're looking for a buy then. It's like same thing here. So this is the January 15th. We close very, very bullish. And as you can see here, January 15th, we were down on Australian dollar. And as you can see, the next few days, Australian dollar is not able to make any go any lower. So it starts to turn around, and gold has already turned around. So this is a good place for us to take a long entry in Australian dollar. Once this starts to base out, it closes like this, and gold has already moved higher, it's time to buy. So even based on daily chart, so this doesn't have to be traded on a 5-minute chart. I happen to be an intraday trader, and I like to close my trades out the same day, but it doesn't have to be an intraday basis. But if you are an intraday trader, you can take this trade on a 5-minute chart, but then you're looking at price a little bit more closely than if you are a longer term trader. If you're a longer term trader, this is very nice, because gold has started moving up, gives you plenty of opportunities to actually get into that trade. And the thing is, you can sit on it for a long time. Look at this. It's just going up one way direction. So even if you entered a little bit early, let's say you entered here, or even if you entered here and it dropped, did another leg down, you could re-enter again here, because your direction is, your entry is a little bit early, but your direction is correct because gold is already going up. So you would expect Australian dollar to follow. And as we can see, gold going up and Australian dollar starts to go up. And over the long run here, as you see gold going up, Australian dollar follows along with it. And then look at this one here. This was a very, very nice signal on a daily basis, actually, because I look at daily candle bars to find direction in the market. I think I've done a little video on that before, but this is a very nice evening star reversal pattern on Australian dollar. So let's take a look at the date here. So this is April 19th, 2016. We see a big green candle close, and then we see a red candle on the 20th, and 21st, we see a drop in Australian dollar. And this is one of the first, well, maybe not the first, but it's a really nice reversal pattern. There's actually another reversal pattern here that goes to the next support and resistance level, and then it turns around. But this is very nice, so we can expect it to go at least to this, right? If not lower, we can expect it to go to the next support and resistance area. So for an intraday basis, we can trade this quite nicely. So now we looked at the long term. So actually, let's finish this off. So we have here April 21st. So let's go take a look at gold on April 21st. April 21st, this is May. April is, oh, I missed it here. So this is April 20th. So April 20th, we saw a big pin bar, and this is our support and resistance right here, goes right into resistance, drops, and then comes down. So the April 21st, we see price close with a big pin bar on top, and the next day, the 22nd, oil comes down, sorry, gold comes down, and here we see on the 21st, we see a drop, and the next day we see a drop here as well. So this can be taken advantage of in an intraday basis here. And then we see market go up. And this one here, this big move to the downside was actually an interest rate cut. So this is what I was talking about before. Let's see if there's a variance, actually, if there's a divergence here. So we see this is 427, and gold, we have 427. Yes, so look at this. So the gold is pushing up and Aussie dropped. So this, we don't want to trade this because there was an interest rate cut. Anytime there's an interest rate cut, that currency is going to drop. So we're not gonna trade that. So just knowing the kind of market conditions you're in can help you very much. And then we see that gold pushed up. Even with the interest rate cut, look at this. It got pushed up. Aussie got pushed up because gold was going up even after the interest rate cut. And normally, if there's an interest rate cut, that's just negative for the currency. So you don't see currency bouncing back. But in this case, because gold had gone up so much, we see that Australian dollar pushed up as well, even with the interest rate cut. But then, so you have interest rate cut, and as you can see, there's topping formation here, this pin bar, and then this candle, 2 pins into this 1300 level for the gold, and then gold starts to come down. And of course, then Australian dollar just comes down right along with it. So Tom just said my webinars are good, but they're too short. So I do 2 different things. I do webinars that are 1 hour long, and then I do short trade examples. Thank you, Tom, for the positive feedback. So I do trade examples as well. So if you're looking at actually a really quick trade example, I posted one on my YouTube channel on Friday, so which is the oil trade. So I do, during the week, I usually do trade examples. It will just be example, not lengthy explanation, just where to get in, where to get out, where the stop loss needs to be, that sort of stuff. And the webinars, I like to keep it within an hour because I know everybody's busy and we can't take away too much time. So that's why I just try to keep it within the hour, but I will do a follow-up on this that relates to bonds and the stock market, so S&P. So we'll do that, another one as well. So let's take a quick look at the 5-minute chart here. Somebody said that they watch it minimum of 5 times. Yeah, sometimes sometimes with any concept, new concept you learn, I always find that I have to go through that multiple times to really get that, because there's always something new that you learn, because information tends to build upon each other, the previous information. So sometimes it takes time. It always takes me when I'm learning new concept, even the market correlations, when I learned it, it didn't make sense to me. I was like, what? And you start looking at it, just open your charts and keep them there. Just look at them once in a while, and this will start growing on you. Okay, so let's take a look at the 5-minute chart. So here we have gold. So let's take a look at Friday. So here is our 5-minute chart, or maybe 1-hour chart, maybe easier to look at. So let's go to 1-hour chart here. Okay, so we have gold 1-hour chart here into the pivot point, and then we have Aussie. So as we can see here, gold dropped on Friday. So we see gold had actually, it pushed up, gave double top-ish kind of signal here on R1, rejection of pivot point R1 here, and it starts to move down on Thursday. And on Friday, it tries to it cannot hold above pivot. So nice reversal candle, engulfing candle here again, pin bar and an engulfing candle. I really like to trade 1-hour pin bars. But so anyway, so double top here, pin bar, a drop. And as you can see in Aussie as well, we see a drop. It tries to push up and then drop down. So you can look for your reversal setup. So when you see gold goes into the pivot right off the bat, drops, you're looking for Aussie. You're looking for Aussie to top, give a topish formation, rejection up top, and you're looking for it to come down as well. So that's the type of thing that I would be looking at. See how this is Thursday and this is Friday here. Aussie tries to push up, then big engulfing candle. This is on a 1-hour chart. So if you don't like to look at a 5-minute chart, which I understand is difficult for a lot of people, you can just look at your 1-hour. See here, tweezer tops. This is a nice reversal signal. So price is just not able to break above this support and resistance area, right? So as you can see, it comes in and drops, just like gold here. Gold came into this support and resistance, pivot point dropped, and as you can see, Aussie here came into the support and resistance, dropped, and then gold went up back to the same level, and here Aussie goes up back to the same level, then gives us a nice tweezer top, pin bar, a reversal signal here, and as you can see here, pin bar in gold, and it starts to come down. So it's good time to take Aussie short here. So this is May 27 at 1100. Let's take a look at Aussie here. This is May 27, 9 o'clock. So this was 9 o'clock, and this is your 1300. So 1100 is right here. So this is the time. So basically, Aussie's running into trouble the same time that gold is running into trouble. Gold drops here, and as you can see, Aussie does the same thing. So you're looking for your commodity to start moving first. So oil or gold will start moving first, and then we'll see that your Canadian dollar, dollar CAD, and your Aussie dollar, they will start following the related commodity. FX Pro, I like FX Pro. I use them for my chart. This is however, I am based in Canada, and they have stopped catering to Canadian customers. So it's not a good broker for Canadian purposes. However, I like them. I like their charts. I like one thing that I really use them for is a news feed. I like their news feed. I used to subscribe to Talking Forex before, when the brokers did not provide news feeds, but now they provide the same news feed except it's free. So even if you sign up for a demo account with them, the reason I like them is because the newsfeed looks the same to me as the Talking Forex did, because it is the same newsfeed. So instead of paying £30 a month for Talking Forex newsfeed, it's the broker provides it for free. So I like that. And that's why and I've been using their charts for years. So I like them as a broker, and I've heard good things about them as broker. All right, so that's it. So basically, just to recap here, we're looking for commodities to move first, then we're looking for currency. You can look at, if you're an intraday trader, you can look at a 5-minute chart like we did in case of oil here. Or if you want to trade more longer term, you can just go off of the 1-hour chart as we saw here. There was topping formation in gold, and we saw topping formation in Aussie as well. So an easy trade to take. It just gives you that extra confidence that it will go down. So it's nice to trade like that. Actually, Linda had mentioned about Brexit. So we talked about Euro US dollar, how Euro and pound were moving in opposite direction. This was because of Brexit fears, because people are concerned that UK will exit European Union, and the polls have been showing that they're not. The polls have been heavy for not to exit, so that's why. In terms of the correlated pairs, Aussie is correlated with gold. So when gold goes up, Australian dollar goes up. When and dollar CAD is negatively correlated to oil. So when oil goes up, dollar CAD will go down. In terms of Brexit, I'm actually not going to trade it, but yes, I think they'll end up staying. Well, this is just my opinion. It's not based on anything, just based on what I see. So Tom's asking a question, do I use pivot points, intermarket analysis, volume, support, and resistance at the same time before entering a trade? And yes, I do. I talk a lot about confluence. To give yourself an edge in the market, you want to see more than one thing lining up in your favor. So if you see that it's coming to support and resistance, your volume suggests that the price is making higher high, but you're not seeing the volume reflecting that, it's time to, potentially the pair could turn. It's hitting into support and resistance. That's good. I like to see that it's coming into pivot points. That's good as well. It gives me extra confidence. So the more things you can layer on your trade, the better your trade will be, because there's multiple things lining up for you. So that's just, I do like to use multiple things to enter the trade. So let's go back over here. So Tom, I didn't understand what you meant by, do you want more than that? So before we wrap it up, just wanted to let you know about my trade room. I run a trade room every Tuesday to Thursday, 9 a.m. to 11 a.m. Eastern. Being a part of Trade Room subscriber, you get my weekly market overview video that I send out every Sunday. And then you also get a daily market analysis video every night, Monday to Friday. This comes out before the UK trading, before the London Open, so that you're prepared for the London Open, and you can take a trade based on that. I usually talk about the market direction, where I am looking for price to pull back, where I'm expecting it to go, the targets that I'm looking for it to go to. And then in terms of the live trade room, I run the live trade room every Tuesday to Thursday. Like I said, 9 a.m. We start at 9 a.m. just after the news settles down. And then we go till approximately 11 a.m. Eastern. And so basically I will tell you where I am entering into a trade. Like I said, I'm not an investment advisor, so I cannot necessarily say that you should take a trade, but I tell you when what I'm looking at in terms of the trade setup, where I'm looking to enter the trade, where my stop loss and take profit will be. I will tell you when I've actually entered the trade, when I'm exiting the trade, and why. So I kind of try to explain what's going through my mind at that point, so that it gives you, so that you can start understanding those things as well. And then there's also a private Facebook group that I've set up for members, where everybody can post their ideas, trade ideas, and have a conversation there. I'm also collecting a media library of trade examples. I've started doing a lot of trade examples where if you don't have time to sit through a 1-hour webinar, you can just go look at this 2-minute or 5-minute trade example where I show you one particular trade setup and then I explain why I would take that trade, and where the stop loss and take profit would be. I do a lot of pivot point. I use my pivot point indicator. That's one of the few indicators I use. So as a bonus, I give you my pivot point indicator if you don't have that already. And the cost of all of this is $99 a month. This is a promotional price. It will go back to $169 a month, but right now I'm running it for $99 a month. And as long as you stay, it will be $99 a month. You can cancel at any time. If you feel you're not benefiting from it, you're welcome to cancel it at any time. And to subscribe to the trade room, you can go to tradingwithvenus.com /work with me. Any other questions? Do you use my FX book for what, Daniel? I use my FX book for looking at COT. They're COT charts. I do a COT, commitment of traders. No, I haven't. I tried setting it up, but the Forex broker that I use is Interactive Brokers, and I don't think it works with them. It doesn't really have that tie-in, and I was kind of running into trouble with that. But what I'm going to be doing, I think starting next month, is I'm going to be publishing just in the trade room. I'm just going to be publishing the result, like actually showing my actual account to see where I sit, but that will include trades not taken in the trade room as well, just to kind of generally kind of share where things go, just as a point of interest. Also will give you a good understanding of, okay, as a trader, what kind of returns you're really expecting, realistic or in terms of a risk to return ratio, I will take 1-to-1 or better. And sometimes what happens is you have all, that's what I have in terms of you may have, like, we may have good risk. We may think the trade will go 4-to-1, but then it could turn around at 10 pips, right? So that's something that even though we can plan for a 10-to-1 or 4-to-1 trade, but sometimes the reality of it is that price, just something unexpected comes into the market and you just have to quit your trade and go away because, staying in it will basically cost you your stop loss. So I will sometimes do that, get out of a trade because market conditions may have changed, but I will take 1-to-1 because I'm an intraday trader. So I do take 1-to-1 or better. But as a long-term trader, the daily analysis, I look at daily bars. I do bar by bar analysis on the daily charts. So it gives a good indication of market, where the market is going. Actually, if you look at I post on my YouTube channel, I post after the fact. So today I'll post all the daily market analysis that I did for previous week. You can go there and look at what I was saying in terms of where the market will go. And it was extremely correct in terms of what the price did. So I think there was one pair that I thought it would go down and went up, but all the other pairs I do on 5 different pairs, and all of that was correct. So, and even if you're in UK, actually, it's a really good time because I usually send out the market analysis just before UK opens. So, in terms of the win-loss, it depends. There will be days when in the New York session, I'm just sitting there and market just goes up and down 20 pips. Literally, we saw a few of those days. But in terms of win-loss, I am more concerned about my profit, and I'm trying to get basically a 5% return a month, really, because I trade multiple accounts. Trying to get 5% on one account. I don't trade London session. I think I'm going back to it. I used to, but I am going to go back to trading London because the trades settle really well in London, especially based on the daily analysis that I do. Those trades play out really nicely in London, so I'm going to go back to it. I have little kids, so I haven't had the best opportunity to be awake in the wee hours because they keep waking me up at night. But now they're growing up. Actually, starting this week, I'm going to do that again. All right, so in terms of the pairs that I trade, I usually trade the majors: Euro, Pound, New Zealand, Aussie, Dollar, CAD. Sometimes I'll get into other pairs like Dollar, Yen. I will get into, I've started doing more of the relative strength. Maybe I'll do a webinar on that, relative strength of currencies. So I will take a look at something that's really strong against something that's weak for the day. I'll do a webinar on that, but that's something that lately I've started looking into. It's just a good way to get a quick trade in. What's the best pair to trade in the evening? Evening pairs, any of the Asian pairs, for example, the yen crosses would be good ones to trade. Australian dollar, New Zealand dollar, those would be good to trade in the evening as well. So the Asian currencies would be the good ones to trade in the evening, just because the market is open then. And so you can get some good trades on, whereas the market in the euro is closed, so it's not... you may not see a lot of movement, but a lot of news comes out, like Australian dollar news, Australian dollar, Kiwi news, and New Zealand dollar news comes out in the evenings as well. Japanese yen news comes out in the evening, and then Chinese data comes out in the evening as well, which has impact on the commodity crosses. So Aussie and New Zealand will get impacted by Chinese data that comes out. So it's a good time to trade those pairs if you're trading in the evening. All right, any other questions before we wrap up? Perfect. So if there are no other questions, we'll call it a wrap. Thank you so much for joining me today. And I have another webinar scheduled for 2 weeks from now. So I'll be, happy to have you on that. Just go to tradingwithvenus.com/webinars and you can register for those webinars. Other than that, enjoy the rest of your weekend, and I will see you on the next webinar then. Bye, everyone.